Alright, covered call. So covered call is a great strategy to increase the returns on the amount which you've already invested in a stock portfolio. So whether you have invested a certain amount of money in a particular stock or you hold a basket of stocks in a stock portfolio, you can increase the returns and even earn a monthly income by just doing this strategy month after month. So let's begin with what exactly is a covered call. So covered call is basically a strategy where you sell one or more call options against a cash holding of the underlying. So what it means is, let's take an example of a particular stock called Yes Bank. So let's say you happen to have 1750 shares of Yes Bank. Now, why did I pick up this number 1750? There's no particular significance except for the fact that one lot of Yes Bank options trades in a lot of 1750 shares. So let's say you are holding an existing Yes Bank portfolio of 1750 shares. Now you want to increase the returns on this. Now you're already holding this, and as we've seen that there are many times when the stock is not going to move unless and until there is a new information which is to disturb the price equilibrium, the stock is not going to move. But you have already invested a capital and that capital has an opportunity cost. So how can you increase the returns or how can you maximize that opportunity cost on the stock portfolio? So what you're going to do is you're already, so this here represents the number of shares which you're already holding. So this is your cash portfolio. So you're already owning 1750 shares. The current spot price is 351. So what you will do is you'll pick up the next higher strike price. Let's take 360. So a call option of at a strike price of 360 is currently trading at 7 rupees per share. So which means you'll collect a total premium of 12,000 bucks, 12,250 to be precise. Now let's roll out the various spot price scenarios at the time of expiry. So what is going to happen here? This is a cash portfolio which you're owning. So this can only gain if the price exceeds 351. So currently you are at 351 and the value of the portfolio is 351 into 1750 shares, which is 6,14,000. So this is the existing value of your portfolio. Now this will increase or decrease depending upon whether the price, uh, as we go along in this contract, will go past 351 or it falls below 351. So let's see what happens. Now we sold a call here. So what will happen here is that we will be earning we have collected a certain premium. So this is how the P&L scenario plays out. So you will observe here that till 367, whatever would have been the gain on the cash portfolio is matched by a net gain. But let's say if the stock price actually rises to 372, then the cash portfolio would have gained by almost 37,000. Whereas our net return, because we sold a call and now the call is making a loss out here, so net of the premium that we've collected, our net gain would be only 28,000. But then a rise to 372 represents almost a 6% increase from where is the current spot. Now, a 6% increase, if a stock were to be bearing 6% return every single month, then monthly compound, if we take a monthly compounding, then in a year, that is equivalent to a 100% return. So if you're holding a stock which is showing a pattern where it is increasing almost 6% monthly on an average, then you are better off just holding the stock as it is, or you could be a bit more conservative in terms of selling a call option. Then we are probably going to pick up two strikes higher. Instead of 360, we'll probably sell a 370 strike and collect a lower premium. So we are going to reduce the total amount of premium we collect and we are going to maximize our gains. But most of the stocks, most of the times, especially in large caps, they are not going to gain 6% on a monthly basis. So any scenario less than 6% is this scenario. So let's say 367. Now if you're holding just a cash portfolio, you would have gained 28,000, and even out here you have gained 28,000. But let's say if the stock were to just move 3.5%, which again is very impressive on a monthly basis. Now your cash portfolio would have appreciated by 18,000, but here you're making a net gain of 28,000 because you sold a call and collected a premium. And likewise here, 356. Had the stock moved to 356, you would have gained just 9,000 on your cash portfolio. But since you have sold a call here, you're now making 21,000 bucks. Now this is something that you can do month after month, and this is how it actually plays out. So let's say most of the time the stock is static, it's not really moving up too much on a month by month basis, and that's how stocks perform. Then let's say if your stock did not move at all the entire year, and sometimes that happens. So what would then be happening? And let's say you're just collecting a premium of 12,000 rupees on an average. So if you collect 12,000 rupees, so in a year you will end up collecting 1,47,000. Now, this 1,47,000 as a percentage of the total amount of capital which you have already deployed in the market is a 24% return. So, even if your stock does not budge an entire year, on this invested capital, you're earning a 24% return. And this 24% represents the aspirational opportunity cost of your capital. And if the stock price were to fall, as you can see here, this would have been your loss scenario if you were just holding a cash portfolio. But on a net basis, by selling a call option, your losses are reduced. So on the downside, your losses are reduced, and on the upside, unless and until the stock is really trending, your gains are maximized because you're now also capping up your regular gains from on the cash portfolio by earning an income by selling a call option against the same underlying holding. So it's an absolutely great strategy. This is something which you must be doing against any of the cash holding you're using. And as an extension of a covered call strategy, even if you're holding a basket of stocks, and most of the stocks are positively correlated with the index. So if you're holding a stock portfolio, you could just be selling a call option of the index every single month, and it plays out pretty much the same way. All right, I hope you enjoyed this. In the next video, we will cover another interesting strategy, straddle, and we look at the various dynamics of it.